Since June 30th, the best performing asset has been crypto. Ethereum is up 54%. Gold's only up 13. Stocks are up, single digits. Well, when we get to September 30th, which is in a month, and if Ethereum is still the best performing asset, guess what institutions will be buying from September 30th to December 30th? There's going to be a lot of FOMO chasing. I think Ethereum could easily exceed its year-to-date highs on that ratio of ETH to BTC. But, does it get to 0.04? Well, if it does, and if Bitcoin's 150,000, that's going to put Ethereum at around 6,000.
All year long, Tom Lee has been telling investors that crypto winter may already be over. And now, as Bitcoin and Ethereum push higher, his outlook is becoming even more aggressive. Lee believes the market has already experienced the kind of reset that historically creates the foundation for a much larger move, and he isn't simply talking about Bitcoin recovering from a correction. He sees a potential new phase of the cycle where improving fundamentals, institutional adoption, tokenization, and artificial intelligence converge to create an entirely different demand environment for crypto. In his latest interview, Lee points to a remarkable divergence in performance since June 30th, Ethereum up roughly 54%, compared with around 13% for gold and single-digit gains for stocks. His argument is that if Ethereum continues to outperform into the end of September, institutions that have remained underexposed may have a very simple problem: they will have to chase performance. That creates the possibility of a powerful institutional feedback loop heading into the final quarter of the year. And Lee believes the upside could be substantial. If Bitcoin reaches $150,000 and Ethereum's Ethereum to Bitcoin ratio climbs towards 0.04, Ethereum would be around $6,000, but getting there may require several catalysts to fall into place. There is the potential passage of the Clarity Act, which could give traditional financial institutions greater confidence to build on crypto. There is the enormous amount of capital still sitting on the sidelines, waiting for the old 4-year crypto cycle to end. There is renewed interest from Asia and investors who rotated into the AI trade. And then there is the performance chasing effect. If crypto continues to be the best performing major asset class, institutions may eventually have no choice but to increase their exposure. Today we're going to break down Tom Lee's case for a much larger crypto move, why he believes Ethereum could dramatically outperform Bitcoin, and the deeper technological shift that could make Ethereum increasingly important in an AI-driven economy. But before we get into Tom Lee's analysis, make sure you hit the like button if you believe crypto's next major move is getting started. Subscribe to the channel for more Bitcoin and Ethereum market analysis, and turn on post notifications so you don't miss our next video. Now, let's get into it.
Our take this year has been crypto fundamentals have been strengthening, which is a real contrast to past crypto winters where those were marked by closures, the absence of capital, and then dwindling use cases. We know tokenization is gaining a lot of traction. I mean, so many high-profile major financial institutions are building tokenized products, particularly on Ethereum. On top of that, we know that as AI capabilities grow, it's becoming very, very obvious that AI agents don't want to use traditional financial systems. And so crypto rails make a lot of sense. So to us, last week is what I would call a course correction, because the price is finally starting to recognize that we shouldn't be in a deep crypto winter. And as you point out, the fact that there was a massive liquidation shows you how offsides the market was. And as the famous John Russell says, all rallies start with short covering. So to us, I think this is the start of a much larger move.
There's been a lot of debate about whether or not we're going to see sort of a retracement or a pullback on here, or on Ethereum and in Bitcoin, crypto overall, after this huge short squeeze. Are you expecting that to happen, or do you think this has kicked off another bull market in crypto overall?
I think there's going to be a lot of if for those who aren't exposed right now, there's obviously a tactical question. And my answer to anybody who doesn't have any crypto right now or is underexposed is, if you look at the past crypto cycles and you could buy the crypto either 4 weeks or 1 week after the low, would you do that every day? And the answer is everyone should obviously be buying 4 weeks before the low or 1 week after the low. So if the low was last week, then you're buying 1 week after the low. If there is a retrace, which is possible, then you're buying 4 weeks before the low. I mean, in either case, I think you should be, thanking yourselves for actually taking that tactical decision. I think if anyone's trying to time the bottom and do what I call buy the middle leg of the rally, they're going to miss the majority of the gains, because we've published the stat, and it's actually worked for more than a decade, that crypto makes all of its moves in 10 days. And if you miss the 10 best days, you actually have negative returns. So how many great days have happened in 2026? Like one. So, I mean, I think that there is a lot of upside for crypto between now and year end.
And I'm curious your thoughts on the drivers of ETH, of drivers of value for ETH for the rest of 2026 relative to BTC. And do you think that breakout is going to hold and continue to play out?
Yeah, I think the ratio between Ethereum to Bitcoin should continue to rise. I mean, I think at a minimum, it should go back to its old high of 0.08. And the reason for that is, one, when we look at the next 5 years, I'm still a very big believer in Bitcoin, because to me it is better than digital gold. It's digital gold, but it functions as a substitute for gold far better. So I think Bitcoin easily has multiples of upside from here. But I think the story that's being written around crypto over the next 5 years has to do a lot with tokenization. And as Vlad said, it's a super cycle, and agentic AI, and really protecting humans and inserting humans into that chain, which we think is a lot of it is, and maybe the majority of it is, maybe all of it will happen on Ethereum. So I think that ratio is going to increase. I think there are catalysts between now and year end. Of course, one of the most important is the Clarity Act. If it does pass in September, it's important for traditional financial institutions. It's not important for the crypto world, but the traditional financial system can more safely navigate now, knowing there is a designated entity that has rulemaking authority on crypto. That is really going to help traditional financial systems start to formally build on crypto. However, if it doesn't pass, it's not the worst thing for crypto, because the crypto industry has already shown it innovates in the absence of regulatory clarity. So I think Ethereum is going to do fine either way, but I think you're really going to supercharge the movement if the Clarity Act passes. The second catalyst is that there's a lot of people on the sidelines, and you started this podcast off with pointing that out, because they're waiting for crypto winter to end, because they're using the 4-year cycle and they're waiting till October. Well, guess what? That's like 5 weeks away. So you're going to have a lot of folks who are short or sitting on cash, or who've left crypto and been trading AI coming back in. And I think that also includes the Asia market. Korea went crazy for Korean equities, but now I'm not bearish on AI stocks, but there is a lot more upside in crypto, which is really what we have viewed as a downstream story to the AI trade. And so you have not only the crypto winter ending, but a lot of cash on the sidelines, especially Asia. That's 3 really huge catalysts. And of course, there's going to be performance chasing by institutions, because since June 30th, the best performing asset has been crypto. Ethereum is up 54%. Gold's only up 13%. Stocks are up, single digits. Well, when we get to June, by September 30th, which is in a month, and if Ethereum is still the best performing asset, guess what institutions will be buying from September 30th to December 30th? There's going to be a lot of FOMO chasing. So now that's the fourth catalyst, which is a huge institutional bid. I think Ethereum could easily exceed its year-to-date highs on that ratio of ETH to BTC. But, does it get to 0.04? Well, if it does, and if Bitcoin's 150,000, that's going to put Ethereum at around 6,000. And I think that's being very conservative, because again, 0.08 is the old ratio high.
Previous crypto winters were characterized by bankruptcies, disappearing capital, declining activity, and a shrinking number of credible use cases. This time, Lee argues, the opposite is happening. Financial institutions are actively building tokenized products. Blockchain infrastructure is becoming increasingly integrated into traditional finance, and Ethereum is emerging as one of the primary platforms on which that transition is taking place. And then there is artificial intelligence. As AI agents become increasingly capable of acting autonomously, the financial infrastructure those agents operate on becomes a much bigger question. Traditional financial systems were designed primarily for humans. People open accounts, initiate transactions, sign documents, and interact with institutions. But autonomous software doesn't necessarily operate according to those same constraints. It needs programmable money, rapid settlement, transparent rules, and the ability to execute transactions without relying on human intervention at every step. That is where Lee sees crypto rails becoming increasingly relevant and potentially where Ethereum's next major use case begins to emerge.
And I thought this would be a good segue into a presentation you recently gave where you called Ethereum the cure for the uncanny valley of wealth. And I thought that this was a really interesting presentation, but could you just start with explaining what the uncanny valley of wealth is and why you think Ethereum is a solution for this?
Yeah, there is this notion of the uncanny valley. So there's a famous Japanese roboticist who wrote about the idea that if robots start to look too human, then people get very uncomfortable. And that's actually true. I think we're going to be very uncomfortable the day we see like androids walking around that we can't tell the difference. Well, the same thing's going to happen with the financial system and your money because agent systems are gaining a lot of capabilities. In fact, we already know that within a lot of these models, the agents are actually buying more of the tokens than humans. So we know that agent activity is picking up. Well, there is going to be a similar uncanny moment regarding your money because once AI systems become part of our economy, they're becoming revenue producing units, potentially even taxable units, and they might be delegated and working on our authority, but what will prevent them from deciding to do their own and make their own decisions financially, including how they access your accounts and execute transactions, which you may have already authorized? That to me is going to be the uncanny valley of wealth, that over time, it is possible that more of our wealth for each of us individually is going to be created by our delegated agents. Are we going to trust them if they're running on Visa rails and JP Morgan accounts to make sure that they're not going to drain our financial resources? I think that's why we want to have crypto, smart contracts, finality, instant settlement, things that are really sort of the nature of crypto to protect us from agent systems going rogue.
Why do you think Ethereum is unique in serving that need in the market and being a solution for that kind of a problem?
Well, it's just one of the things that I think people don't really appreciate, especially someone who might be writing code or actually just whiteboarding, is the network value, the network effects of a widely used system is hugely underappreciated because people don't know how to monetize that. For instance, why do we all use dollars? I mean, there's plenty of liquid currencies, but because the dollar has not only been the most accepted and, as people say, has been around the longest, but why would we use anything else? Well, that's true of almost every asset, whether that's real estate. Why do we own land? Why do we trade in the US stock market when Korean stocks are cheaper? Ethereum is the largest by a country mile, the platform that is not only has the most number of wallets, the most activity, but is also the place where financial institutions are already building. So the question you'd have to ask is, if financial institutions who've now chosen to use a public blockchain, would they suddenly want to be betting on a new illiquid chain that could actually have problems in the future with code or adoption, or there could be problems with their market maker or their node operators? So we're creating a whole series of cascading problems when the reality is that Ethereum actually is the platform of choice today.
The first stage is already underway. The market has rallied sharply. Short positions have been forced out, and investors are beginning to recognize that the fundamental backdrop looks very different from the crypto winters of the past. From there, Lee sees several potential accelerants: regulatory clarity, sidelined capital returning, renewed Asian demand, institutional performance chasing, and the continued expansion of tokenization. If enough of those catalysts arrive simultaneously, the market may not need much additional fuel to produce another major leg higher. And there is another catalyst that could determine how much fuel is available: the Federal Reserve. Today, markets are watching Kevin Warsh deliver his first Jackson Hole speech as Fed chair. With inflation, interest rates, and the recent volatility in the Treasury market at the center of attention, Warsh is under pressure to clarify how the Fed intends to deal with inflation that remains above target while long-term Treasury yields remain elevated. Markets are also trying to understand whether his approach will be hawkish enough to keep inflation expectations contained, or whether he will provide a framework that gives investors confidence that monetary conditions can eventually become less restrictive. And that brings us back to Tom Lee's bigger thesis. The question isn't simply whether Bitcoin reaches $150,000 or whether Ethereum reaches $6,000. The more important question is whether crypto has entered a fundamentally different phase one, where institutions are no longer viewing these assets purely as speculative instruments, but as infrastructure for tokenized finance, digital assets, and eventually an economy increasingly populated by autonomous AI agents. If that transition is already underway, then the recent rally may be less about the end of a bounce and more about the beginning of a much larger repricing. And if Tom Lee is right, the most explosive part of this cycle may still be ahead of us. If you enjoyed this analysis, make sure you hit the like button. It genuinely helps the channel, and subscribe if you want more deep dives into Bitcoin, Ethereum, macro liquidity, and the forces shaping the next phase of the crypto market. Turn on post notifications so you don't miss the next video. And as always, thank you so much for watching.